Hello, and welcome to the Inside is Capital podcast. I'm Pierre Daly, managing editor at advisoranalyst.com. There's a tug of war going on between bulls and bears, and it has continued well into September between those who believe the Fed has done enough for now to tame inflation and those who believe the Fed has much farther to go. Rates have been moving against equities and bonds, and with correlations for many risk assets rising to 1, it's anyone's guess as to what comes next. Joining me to talk about both the bullish and the bearish theses is Martin Lefebvre, CIO at National Bank Investments. Martin has 20 years of experience in the financial markets sector, where he has held various key positions. He joined National Bank in April of 2012 as a strategist before moving on to private banking 1859, where he oversaw the portfolio management team. As Chief Investment Officer, he is now responsible for the development of investment solutions for National Bank Investments and the management of tactical asset allocation mandates. Prior to his years at the bank, he worked at NatCan Investment Management as Vice President Asset Allocation, where he was responsible for the portfolio management of several multiple asset class mandates. He also served as senior economist and strategist for Desjardins Group and as U.S. economist with the Canadian Ministry of Finance.
This is the Inside is Capital podcast.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of advisoranalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Martin, welcome to the show. It's great to have you.
Thank you very much, Pierre. Happy to be with you.
Martin, before we get talking, please tell us about the arc of your career, how you got into the investment industry in the first place, and what you've been thinking about and working on these days.
Yes, so you've touched about my bio a little bit, but if I go into more details, I graduated somewhere around the end of the 90s, and really there was not that many jobs around, certainly not in Montreal in that sphere of activity. So I started, as you said, as an economist for the Government of Finance in Ottawa, but I rapidly moved to the banking sector, where I worked as an economist for about, I would say, 10 years, and I really loved every aspect of the job. I worked closely with capital markets, bond desk. I was in charge of the FX forecast and the bond markets forecast. So it was really following very closely everything linked to central banks and everything that's really aligned with everything that they do. So really fundamental analysis. And then the problem is that when you're working within an economist group is that you're sort of in a silo. So to move on or to do a different aspect of your career is very difficult once you're into that path. But I guess my big break came in 2010 when NatCan was searching for a PM for its asset allocation mandates. And I did that with some success for a couple of years, but after the firm was sold to Fiera Capital, switched back to the sell side, and I worked as a strategist for the wealth management division at National Bank. And soon after that, I took over the management of the investment solutions for a private banking division, and I guess somebody thought I was doing a good job, because really just a few years after that, I was put in charge of overseeing all of the bank's retail investment solution. And since then, you were asking what I was working on. We've added an OCIO offering, and we're working very closely in collaboration with our institutional clients.
Did you ever imagine you'd be here doing this when you were younger, when you were still in school?
Oh, that's a good one. I mean, if you go back, I mean, when I was a kid, I wanted to be a stuntman, so I guess I didn't have that in mind. So I was more the action type of kid, so I never really figured myself sitting in an office chair all day. But what I've learned through time is that I was only looking for challenges and opportunities, and finance really is all about that. So maybe I got the fever for all of this, watching Wall Street's Gordon Gekko in 1987. That's really where it all came about, and that's when I decided to take business and economics classes back then, just before university. But I could tell you that ever since my first job in the domain, I knew I was at the right place, and I knew that I would do everything in my power to lead and build a research team. That's really what I like, and I guess the rest just came naturally with a good dose of hard work and probably a bit of luck.
Now that you've attained this role, your current role as CIO at National Bank Investment and strategist at National Bank Investments, what's one thing that really is everything you thought it would be, and conversely, one thing that wasn't?
Well, Pierre, that's a very good question. I mean, being a CIO is everything about making the right analysis, putting together thorough investment processes, making tough decisions, and sticking with the plan. But it's nothing about managing a black box or trying only to add value on a relative basis. When you're a portfolio manager, beating the benchmark is the only thing. But when you're a CIO, you need to understand that there's a client at the end, and that outperforming in a down market sometimes doesn't cut it. So absolute returns is also very important. People have life goals and they're counting on us. So you need to think about communications, volatility, risk management, and most importantly for many clients is time horizon.
It's been a volatile year to date for both stocks and bonds, with inflation at 40-year highs and rates on the rise. In your day-to-day conversations, what's keeping your clients up at night?
Yeah, that's absolutely right. I mean, most people you talk to have known nothing but disinflation, even if you were in the market, at the beginning of the 80s. So seeing inflation at a 40-year high is a bit of a surprise for most people, even people I work with. I mean, most of them are around 30 years of age, so they've known nothing but an up market practically. So wages are rising, but certainly not enough to keep up with the price increase. So I think that households will make some tough choices going forward, especially in a rising rate environment. So you were asking what's keeping my clients up at night. I mean, usually when the equity market goes down, there's always sort of a balancing act with the bond market sort of offsetting that. But the problem now is that equities are going down because yields are going up. So whenever yields are going up, obviously it means that the price of a bond is going down. And really what's happened was really difficult to swallow for all those investors that are more conservative in nature. If you look at a statement, you'll see that most bond strategies are down significantly over the past year, certainly since the beginning of the year. So once clients get their statement, they will see that even in a very, very secure positioning, there's nowhere to hide, and that's pretty much the big problem in this cycle, is that everything is in the red, unless you were invested in commodities and even more so in the energy sector. Everything is in the red. I guess the only true safe haven nowadays is the U.S. dollar, but even that has gone up so much that it's becoming a problem for many nations. So most clients are facing that, and it's difficult to understand and even to explain to them. But I think the worst is kind of behind us, and we can look forward, even though it will remain difficult for equities in the near future. That probably from the bond market holders, that the worst is probably behind us.
Yeah, I mean it's definitely a pivotal time. This week is definitely marked by the September Fed meeting upcoming. I mean, we don't know what's going to we don't know fully what's going to happen there, but you have a pretty good idea with so far what's probably baked in to the Fed's thinking in terms of the odds of a 75 basis point rate hike. But in the foreseeable future, what are your thoughts on the market now and for the foreseeable future? Objectively speaking, what's the bull thesis here? And conversely also, what's the bear thesis? What are the odds at some point in the foreseeable future that the Fed turns dovish, for example?
Well, we don't see that coming in the near future. That's for sure. I mean, one thing that's going to happen with the Fed probably raising rates by 75 basis points, as you alluded to. But the message will be clear that they're not about to make an about turn on their strategy and start lowering rates soon. So probably the dot plot will change, where those more dovish at the FOMC were kind of saying that it was a possibility for rates to be cut in 2023. I don't see that happening. If they keep raising rates after this coming Wednesday, and they will probably continue to do so until the end of the year, it's going to be very difficult for them to start cutting rates soon after. So they've made inflation their main combat, and I think that unless it drops significantly, that they're not about to change their tune. On the optimist side, or the more optimists out there on the street, they're kind of saying that inflation inevitably will drop very significantly over the coming months, and that should be enough once inflation drops below the Fed's key rates. It will be enough for them to maintain rates either at that level or even to cut them soon after that. But the pessimists will say that even though they keep rates at the current level, it's going to take some time for all of the impact of raising rate environment to have a negative effect on consumption, starting with the housing market. So we're seeing that. It's even more so in the U.S. than in Canada, but in the U.S. it's pretty clear that the U.S. market is heading towards very difficult times. And once the housing market goes down, then consumption soon will follow. And we're in a bit of a pent-up demand where we weren't allowed to go out, restaurants, to travel, and all of a sudden everything is reopened.
Right.
And we just transferred from buying goods at home to doing everything that we couldn't do over the past couple of years. So there's been really a lot of demand lately, a lot of activity, especially in those sectors. But when you look at plane tickets, double the price that they were before the pandemic. Going to restaurants, for sure, Pierre, that it's much more expensive than what it was. So everything has gone up, and at a certain point in time, then households will have to make some very tough choices. So for us, it means that that tug of war will probably continue. But yeah. I guess that the big positive in all of that is that we're not really seeing some big unbalances like what we saw during the Great Financial Crisis, where lots of loans were made to make sure that the property ownership rose in the U.S., and eventually that has led to a banking crisis. So we're not seeing that. So hopefully we're seeing that even if there's a recession, it might be very shallow and short-lived. So that would be the big positive in all of that, where the chance of not going into recession right now is very low. But if we can, manage to if it's short-lived, then I guess that the market doesn't have to go down typical bear market 40%. So that's kind of the thing that we need to monitor very closely in the very near future. Yeah.
It's interesting. I some of the voices in the market have been almost lobbying. You'd have to say it sounds almost like lobbying the Fed publicly through commentary to, do this upcoming rate hike, but then stand down and take a wait and see approach and see, how everything pans out over the next 18 months of the already existing rate hikes. Not necessarily to take a dovish stance, but just literally just to stand down and wait and see.
Yeah.
While of course others are saying no, this is going to keep on happening until the inflation volatility is under control, until the rate of inflation growth is subsiding. In the context of what's been happening for most of this year with regards to the shift in regime that appears to be happening towards tackling inflation, rising rates, how has your allocation changed from the beginning of this year until now, and what are some of the most recent allocation changes that you've made, and why?
Yeah, good question. Just to go back a little bit, recall that we ended 2021 really firing on all cylinders. So
Right.
Clearly the market was already positioning for probably some technical pullback. So that remains to that was the environment that we were working with. So big drop last at the beginning of the year. That was more technical in nature than anything else. But soon after, we saw that clearly the market was looking for direction, and there was lots of unforeseen events. I mean, nobody could have really said that there'd be a war in Ukraine, so that kind of put oil on the fire. That China would go back to total confinement. So that was, I guess, some people could say that was predictable, but it was kind of difficult to predict nonetheless. And the way our model works is that we tend to stick with fundamentals. I mean, there's always risks, right? And eventually one risk goes away for another one to add to the wall of worries. So there's always risk. So we started the year fully invested in equities, but it didn't take long for us to change our tune, and we went defensive. First, we went to neutral, and then eventually we went to being defensive. The big problem, like I said earlier, is that even though we kind of saw that equities were in a tough spot, the alternative being bonds most of the time for asset allocators, it was difficult for us to convince even ourselves that it was the time to buy bonds, and bonds fared even worse than equities in the first couple of months of the year. So we were massively underweight bonds. We stayed massively underweight bonds for the first quarter, and that's really what paid off. Even though equities, went down, bonds haven't, fell even further than equities. We managed on a relative basis to make a few basis points for our clients. But now I would say that we've raised liquidity. We like cash. I mean, cash is yielding somewhere between 3% and 4%. The highest level since 2008. I mean, it's back in our the list of the possible universe. Just before that, it wasn't something that we even looked at. But now liquidity is good. Bonds has become more attractive. I mean, benchmark yields are yielding 3.50 now in the U.S., a little bit less in Canada, but the bond investors can expect to have somewhere around 4% or even 5% if you buy corporates here in Canada. So if you're patient, probably yields could always go a little bit higher for as long as the central bank's message is that they're not done with their monetary tightening. But I guess the worst is behind us, and if you really expect inflation to come down, or even worse, a recession to take place somewhere in 2023, then yields obviously will go back down, and bondholders would probably recoup all of the loss that were incurred during 2021. So I guess my big message is you have to be patient, you have to stay invested, but clearly prudence is of the essence for the next 6 months or so.
Yeah. Speaking of bonds, there's both an opportunity to collect some yield from bonds with rates having risen the way they have. But as you said, there's also the tactical opportunity that if yields come back, given a slowdown in inflation or a recession, we'll see yields come back, and therefore a tactical opportunity to have some gains as well from the bonds. What about sectors like energy, and are there any key sectors that you like right now where you would have an overweight and any sectors that you specifically have underweighted?
Yeah, so I guess this discussion is more for equity portfolio managers, because wherever the sector you invested in on an absolute return, there's a fair chance that's going to be negative, right?
Right.
But on a relative basis, I guess that defensive sectors, whether utilities or not, or whatnot, staples, consumption staples will probably do better. Everything that's linked to interest rates, for interest rate sensitivity, technology stocks, not to name them, I would stay away from those for the time being. But eventually, if yields do go back down because of everything that we just said, inflation going back down, and probably the Fed fighting the coming slowdown instead of inflation, that would probably be a good time to switch back into growth stocks. I would shy away from everything linked to cyclical stocks. I guess that trade was the end of 2021 and the beginning
Right.
of 2022, but now it's already behind us. I mean, oil prices, we've already seen the big jump. The energy sector is up, big time. I don't see any upward momentum from now on. It may stay fairly. It may be all right for a couple more months, but I guess that trade is really behind us. And if there's indeed a coming slowdown, then even those sectors will feel the brunt of the slowdown. So I would be prudent sector wise going forward.
So for the time being, you've been increasing the dry powder in the allocation, raising allocations to cash, taking a more defensive portfolio stance to more liquidity, and shorter duration.
Absolutely, but recall that at National Bank, what we do is we do the asset allocation. We choose the assets we're invested in, but we outsource to active portfolio management in external firms. So they have the mandate to add value no matter what the environment that they're in.
Okay.
That decision remains their own.
And Martin, what are some of the unique features of you and your team's asset allocation framework?
Well, that's a good question. I just alluded to our approach, so it's a good segue. I mean, and basically, Pierre, our approach is three-pronged. We start by building portfolios based on historical risk premium. That's really how we come up with the risk profiles for our client. But that's if we couldn't do anything else. So obviously, on top of that, we tend to add what we call a strategic layer. And that's based on our long-term market expectations that we do annually. We revise them annually. The next publication should be out shortly. I think it's supposed to be out by the end of the week. And that's where we had peripheral strategies like whether it's alternatives, real assets, or private equity, or that's where we decide to be overweighted plain vanilla asset classes like stocks or bonds, or go underweight or raise cash or stuff like that. So basically, our target is to beat a plain vanilla portfolio, finally, to keep a very flexible approach in all of our solution, we're adding a tactical sleeve where we capture the opportunities of changing market environments and mispricing. So, like I said, because we outsource the active management of our solution externally, it's very difficult for us to say, okay, it's time to be overweight Canadian equities or US equities. So we have a tactical sleeve in pretty much all of our portfolio solutions. It usually amounts to somewhere around 10% of the solution. It's passively managed, whether in futures or in ETFs, and we can be very, very, very flexible with that approach. In a matter of a day, we can go from overweight equities to overweight bonds. So that's given us a lot of flexibility, and that's enabled us to capture some good opportunities over the past couple of years.
Martin, is it safe to say that your office your CIO office is maintaining a high degree or is maintaining all the objectivity that you can possibly maintain? You're not married to any particular vector or outlook in the market. You're not making bets on the direction of the market. You're mainly analyzing the market objectively in order to see where the flows are, where the ebb and flow of the market is, and what directions different areas of the market are heading in, and monitoring it.
Yes, you're absolutely right. I mean, we're analyzing the markets on a daily basis, but we're also trying to see the big picture.
Right.
And whenever we come up with an idea, whether it's to buy real assets or infrastructure or to go into commodities or we search the planet for the best managers and we just allocate them. They're competing against each other, so we're just trying to come up with the best strategy possibly, and then we allocate the mandate to the best managers out there. And because of our pricing power, because every time we allocate mandates, it's in the midst of 500 million and mostly billions. Usually we get very good pricing power also for our customers. So that's probably a good advantage or a differentiator that we have from most of our banking competitors, not to name them.
Within the mandates that you manage, how do you and your team work in terms of overseeing the assets that you directly control?
Well, yeah, that's a good question. So I've talked about our open architecture approach earlier.
Right.
So we do have a team that manages that. They do due diligences on all of our external portfolio managers. So that's really their job. I come up with the idea, and then they do come up with the best in class, and then as a committee we choose. We only retain the best ones, and then it's their job to make sure that on a regular basis they meet with them and make sure that they're still aligned with the mandates that we give them. What we do in my team is that not only we come up with the strategy, but we also manage the tactical sleeve, that portfolio I was telling you about. So it's I guess it's somewhere in the neighborhood of $7 billion, I guess, that we're managing, and we're doing that in my team. So we come up with a strategy, we make the decisions, we follow the markets on a daily basis, and that's given us all of the, like I said, the flexibility to make sure that the clients are the best aligned in any type of environment, really. And that's worked fairly well for us over the past couple of years. We're knock on wood, we were able to add a lot of value for our clients doing it that way.
How much do you think at this point the market has discounted? You've already said that you think that the worst is behind us. So in other words, you also must believe that the market believes that the worst of these policy changes is behind us. Yeah. And the worst of the news that's happening is also behind us, given geopolitical events, the war in Ukraine, supply shock, reopening of the economy, and all of the pressures that has put on inflation. So how much, maybe I'm answering the question for you.
Yeah, but markets don't like to be idle. They're always looking for direction. Yeah. So sometimes it's only tactical in nature. If things go too far, they're waiting and just for the markets to go back up. But the general trend remains down. When I say that probably the worst is behind us, is that, remember, somewhere in 2021, benchmark yields were hovering around zero, and they went up to 3.5% in a matter that was almost never seen before. So being long, very long duration in nature, I mean, the hit to the bond market was the worst probably ever. Remember in the 80s when yields were when yields went all the way up to almost 20%, coupon rates were also very high. So that kind of affected the total return aspect of the bond return. But nowadays you don't have that. I mean, coupons were at zero. There was a huge premium on most bonds, but now, I mean, yield to maturities are somewhere around 3.5, 4%, and there's a discount for buying a bond. So, I mean, yields may well go up a little bit more, like I said, until the Fed is done or central banks are done generally. But I guess the worst is probably behind us for in terms of the bond direction. Now, equities is another thing. And it remains to be seen what's ahead of us. But I guess if we revisit the lows of last June, markets will go back in bear market. Will be down 24-ish, 25%, and then we'll have to see how much bad news is still to come, or if most of those are already priced in. But what we do in our day-to-day monitoring is that we try to stay as rational as could be in our decision making, and to do that, there's a wide array of metrics that we follow. And because we consider ourselves evidence-based, everything is gathered through in-house models where we add different signals ranging from monetary conditions, cyclical conditions, and market sentiment in a way to quantify our risk positioning. Like I said, we kind of believe that we're the last line of defense for our clients, so we want to stay as rational as possible in our decision making, and that's why we tend to have the need to quantify all of our decision making. But like you said, there's still a lot to factor going forward. And like I said, we're still waiting for the behavior of the consumers to change. There's never been a recession, whether in the U.S. or in Canada, not involving a slowdown in consumption. And I guess the big positive, if I try to compare the current downturn with other recessionary episodes, is that, like I said, there's not that many imbalances, but firms are all right. Their balance sheet is clean. Same thing with households. I mean, there's been a very sharp rise in many metrics concerning households. I mean, net worth has gone up like never before, and although the stock market is down since the beginning of the year, the last 10 years were almost abnormal in returns for many investors. So a lot of people got really rich over the past couple quarters or years. And because of that, we think that their balance sheet is also fairly good, and they'll probably be able to weather any type of storm. And like I said, hopefully our base case scenario is for the coming recession to be shallow and short-lived in nature.
Right. So some lasting wealth effects from the last decade are providing pretty significant cushion for the consumer, right?
Absolutely. Yeah. Absolutely. Yeah.
You mentioned alternatives. What role are alternatives playing in your asset allocation model?
A big role, actually. We're looking at that. We've added some, like I said, now yields have gone up, so bonds will probably, be more in vogue for the foreseeable future, much more attractive. But the past 5 years has been yields will go up eventually, and we need to prepare for that. So we switched. We took a lot of our positioning in bonds to invest that in cash-like securities. So whether it's infrastructure, whether it's timberland and agricultural funds. We bought a lot of real assets over the past couple of years. We're also invested in what we call non-traditional fixed income. So we're trying to buy some opportunities. We're trying to go buy into spread products instead of just buying the coupons. So that's added also a lot of value, and we've invested a lot of our time and effort into the private market. So whether it's debt, infrastructure, like I mentioned, but also in private equity, just to make sure that our spectrum is or our universe is as wide as possible to capture every possible opportunities for our client going forward.
Excellent. And Martin, what are some of the areas? I think you may have covered this already, but I think I should still ask you.
Yeah.
What are some of the areas of investment or opportunity that you want to highlight for investors? I know you mentioned cash. The U.S. dollar is very strong and appears like it might, appears to have some durability in terms of continuing to be stronger for at least a little while. And cash, of course, is building up some dry powder in portfolio allocations. But are there any areas of opportunity that you'd like to highlight?
It's probably too soon to try to reverse any trends. Like you mentioned, the U.S. dollar is really strong. It's probably the strongest it's been in a long while. And usually, when there's a downturn, the look for safe havens is always favorable to U.S. dollar. But the U.S. central bank or the Fed is always the first one to hike interest rates. It's always been like that. And usually there's a sort of a 6-month lag before the rest of the world catches up to the Federal Reserve. So before that happens, and we just saw the ECB starting hiking its own monetary policy, but there's no way in my mind that the ECB will be able to raise rates all the way up to wherever rates the Fed is taking the markets,
right.
Because of the difficulty or the structural difficulties that Europe is facing right now, the energy crisis. I mean, there's so many things that will prevent the ECB from hiking interest rates all the way to the levels that we're seeing here in North America. So for the time being, I would say that although the U.S. dollar seems to be overbought, it would be difficult for us to really bet against that in the very near future. Cash is just, an opportunity that was taken off the list, over the past couple of years because yields were brought down basically to zero. Nowadays, it's sort of an alternative. If you think bonds will go much higher, then cash is probably better for you. And if you think that equities will correct because there's a recession coming, then again, cash is probably a better alternative than it was, for a very, very, very long time. But I would tend to stay very prudent in the near term. But just to remind everyone, risk aversion, if you get out of the market, risk aversion will prevent you to go back into the market. And don't forget, there's already 20% of the downturn that's already priced in. There might be another 10% or even a 20% downturn coming ahead of us that would be in line with historical bear markets going all the way back to the early 1950s. But since there's not that many imbalances in the economy right now, it doesn't have to be that bad. So just because of that, recall the importance of being invested, and because the first couple of months following the rebound are always spectacular. I guess the signal this time around will not come from the Fed saying that they're done with tightening monetary policy. That may give way to a rally, but the big jump or the big turnaround in equity market will only come once the Fed signals, or it's given us the message that they're about to lower interest rates. That's always been the pivotal signal from central banks. So I guess be ready for that. Once that happens, the market will go back up, and that'll be the beginning of another very long cycle. I'm pretty sure of it.
That's terrific insight, Martin. What's one thing that sets national bank investments apart in your mind?
Well, that's a very good question, but if I had to think, it wouldn't be one thing; it'd be everything.
Okay.
I mean, starting with the culture, adopting the bank's value of making a positive impact for the community, for our clients, for our employees, the way we work in close collaboration with our partners. I've mentioned our open architecture approach, which gives us the ability to choose and retain only the best managers everywhere on the planet. And like I said, at the best price. So that's a big differentiator for us. But above all, I guess it's our people. We've really put every effort in raising the bar to attract and retain the best talents, and to be a destination of choice for our employees, and that it's really paid off in recent years. So yeah, if there's one thing I guess that sets out our parts would be our people.
Thank you for sharing that. So this is a time for prudence. Maintain your asset allocation. In other words, stay invested. This is not a time to jump out. You mentioned. I would say that the implication of what you said just now about remaining invested, remaining in your asset allocation, is that things obviously can change very quickly. They can turn on a dime, and if you've already been through the worst of this year, getting out now would be one of those terrible behavioral mistakes that investors make quintessentially, which is getting out at exactly the worst time possible and then missing the recovery. Any parting thoughts?
I guess you're right about that last statement, and it's all linked to risk aversion. If you get out now, it probably if equities continue to go down, that would be a good thing. But the importance going back into the market also at the right time, and that's a very difficult decision to make. But I would add that volatility will remain with us in the foreseeable future. That's for sure. What we're seeing also is that when yields do go back up like they just did, usually the correlation between bond returns and equities goes back to positive. So it means that there's going to be some very good times ahead of us, but the bad times can be also worse. So there's not going to be much diversification from bonds going forward. So I guess diversification will remain key. You need to look at every aspect of the environment universe going forward. That's one sure thing that will remain.
One last question. What's a hobby or personal interest that you could talk about for hours?
Oh my gosh, yeah, I do lots of things. I mean, I've built my own cottage. So yeah, that's kept me busy for parts of the last couple of years.
Fantastic.
Yeah, every weekend, and it's almost finished. I mean, it was a boon to have that during the pandemics. We spent a lot of time there with the family. I'm a boat guy. I'm always on the water. So I love doing that, water skiing, surfing, stuff like that. That's the kind of thing that I like. But fall is upon us, so we'll probably go for hiking in the trails in the backyard. So that will be fun too. I'm looking forward to it.
Well, Martin, you weren't kidding when you said you were an action guy.
Yeah.
Martin, thank you so much. That was a terrific conversation. Very excited to chat with you today.
My pleasure, Pierre. Thanks for having me.